Friedberg, we discussed this article from Seeking Alpha, which came out on, let me get the exact date here, December 19th. Title of this Seeking Alpha story is SVB Financial, blow up risk. And the summary in 3 bullet points says, bullet point 1, potential losses in loan portfolios could severely impair book equity. Number 2, unrealized losses in hold to maturity portfolio already equal to book equity. Number 3, funding environment for startups will pressure deposit base, adding even more pressure to the balance sheet. In other words, startups spending money to cover their burn rate. Friedberg, and obviously we had the Dodd-Frank rules loosened under the previous administration. And that specifically was driven by Silicon Valley Bank. That had a big part in that. So looking back on this, and people do want to place blame, let's talk about the effects that occurred, because this was hiding in plain sight, literally in December, in an article that looks like it was written by somebody who went into a time machine and said, how do I warn people in December about this? Maybe you could talk about the Fed's interest rates, the spending, and what led up to this issue with the banks.
You guys remember when we started this podcast 3 years ago? We were like, they're going to shut down the economy. There's going to be crazy second and third order effects of doing that. No one knows what they're going to be. Here they are. And I think that's like the root of what is a rippling effect. You can't shut down the global economy and stop trade and stop people and have the government step in to write a giant check and not expect that you're going to have to cash that check at some point. That's effectively what I think we've been kicking down the road here. The way we initially tried to resolve the problem was to drop rates to 0 and then spend our way, back to a growing supported economy, and then overshot, ended up with, too much stimulation, too much stimulus, too lower rates for too long, responded too quickly, whiplashed back. At the end of the day, there was a giant gaping hole blown into the global economy when we shut down the world from COVID. There's no blame. It's just what happened. And when that happened, there was a massive cost that had to be borne at some point. And it's going to get borne at some point. And the rippling in a pond, you don't know where the ripple is going to hit, what part of the pond, what leaves it's going to hit. That's what's going on still. And it's such a dynamical system. It's so hard to say with linear certainty, this is what should be done and what could have been done and what they should have done at the time. No one had that predictive capacity back then. They did what they needed to do. People thought that they should have dropped rates. They said we should have written all these big stimulus checks. Some people said you shouldn't. Some people said you did. Certainly, some people are being proven right and some people are being proven wrong. But at the end of the day, the economic loss that was realized at that period of time, we're still trying to get out of it and we're still recovering from it. And I think that's a big part of what's being eaten up right now. And you're going to see it in the wipeout of certain equity. You're going to see it in the wipeout of these banks, of the assets that they hold and these portfolios. And the effects of that are obviously, still being felt.
Sachs, do you agree that mistakes, that there isn't somebody to blame? Because it is clear that the Fed said inflation is transitory. That was wrong. And then they went faster than in history to raise the rates. Those seem like two glaring mistakes. And then the Dodd-Frank loosening under Trump and with Silicon Valley Bank pushing them, that seemed like a really big mistake.
By the way, I wasn't saying the Fed's not to blame for not raising rates fast enough.
Okay.
That was, because you guys remember, I was the first person to talk about what Stan Druckenmiller had said, that they're not raising rates fast enough, that we've got massive inflation, we should have been raising rates. I was the first person on this show to be, barking that. So don't forget, I was there pretty early. What I was pointing out was we shut down the economy during COVID. The global
that is
economy.
The main, I got you. So that's the main cause.
That is the cannonball that got blown through the ship.
Got it.
And everything else is plumbing and patching and work to try and keep the ship afloat. And we're still dealing with that. And at the same time, as you guys know, we've been loading the ship up with debt, the global ship, the global economy with debt, 360% global debt to global GDP ratio right now. And as that ship has gotten heavier and heavier, to have a giant hole blown in the side while you're trying to do all this patchwork with all this debt weighing on it, it's a critical challenge. And it's one that we're feeling acutely here. They're feeling it in Europe now. And we're certainly going to see the global ramifications as we try and fix this economic catastrophe that was caused by COVID, at the same time that we've been spending our way into a happier future that it turns out we have to pay the bills for at some point.